Imagine waking up in 2030, buying a house with a 50-year mortgage, and your grandkids are still making the last payments. That's not a dystopian meme. That is very close to being actual U.S. policy if Donald Trump gets his way. And here's the crazy part. For some people, this could make housing finally affordable, while for others, it could send prices into orbit and lock an entire generation into debt they never outlive. Welcome to the comment section with Thomas Paul. Today we're breaking down Trump's proposed 50-year mortgage plan, how it could change the U.S. housing market, and what it means for you if you're a buyer, a renter, or an investor who likes cash flow more than sleep. Let's start with what this thing actually is, because 50-year mortgage sounds like something a bank would pitch right before a financial crisis. The idea on the table is to extend mortgage terms from the current standard 30 years to up to 50 years, likely backed or supported in some way by the federal government. The political sales pitch is simple. Spread the payments over a longer period, your monthly payment goes down, and suddenly, that house you couldn't afford at 7% interest is back on the menu. And here's where things get interesting. On paper, it kind of works. Picture a $400,000 house at a 7% interest rate. On a 30-year mortgage, your monthly principal and interest payment is roughly in the ballpark of $2,660 a month. Stretch that to 50 years at the same rate, you're closer to around $2,400 a month. So just by adding 20 more years to your loan, you shave off a couple $100 a month. Politicians look at that and go, boom, problem solved, housing affordability. But wait, it gets wilder. That lower monthly number is exactly what sellers, builders, and banks also see. If buyers can afford $2,400 a month instead of $2,660, guess what usually happens in real life? Prices shift up until the monthly pain level feels the same. It's like giving everyone longer forks at a buffet and pretending they're not going to pile on more food. So let's break down the key takeaways from this 50-year idea, in plain English, with as little political fluff as possible. First, yes, it would absolutely lower monthly payments, at least initially. If you're a first-time buyer in a high-cost area, especially if rates stay higher for longer, a 50-year option could be the difference between nope, can't buy, and okay, I can kind of swing this if I never go on vacation again. So in the short term, that looks like a win. It increases the pool of people who can qualify for a mortgage, especially at today's prices. Second, it dramatically changes the math on how much interest you pay over time. Stretching a loan from 30 years to 50 years doesn't just stretch the calendar, it explodes the total interest. On that same $400,000 example at 7%, over 30 years you're paying in the neighborhood of close to $558,000 in interest. Over 50 years, that total interest can easily shoot well north of $900,000, so you're paying more than double the house price in interest alone. Because nothing says American dream like paying for 3 houses and only getting to live in one. Third, it slows down your equity building to a crawl. In the early years of a mortgage, most of your payment is interest, not principal. That's already true for 30-year loans. On a 50-year loan, that effect is like equity in slow motion. If you plan to stay in the house for just 5 to 10 years, you might barely chip away at the principal before you sell. That means less equity, less flexibility, and more sensitivity to home price drops. If the market dips even a little and you haven't built much equity, you're one job loss away from being stuck or underwater. Fourth, it changes the risk profile of the entire system. Banks love long-term predictable interest streams. Investors love steady cash flows. Politicians love anything that makes charts look nicer before elections. But stretching the risk over 50 years assumes something very bold: that the world stays reasonably functional for half a century. The odds that something goes sideways, economically, politically, or in your personal life, over 50 years are, let's say, non-trivial. So on one side, you've got affordability and access. On the other, you've got more total debt, slower equity, and systemic what could possibly go wrong. It's a vibe. Now let's zoom into who actually benefits here, because that's where the story really gets spicy. First-time homebuyers in expensive markets? Short-term, they benefit. If you're in California, New York, or literally anywhere a starter home is $700,000 with a leaky roof, then yeah, a longer-term mortgage could be the only way your payment fits under your income. High-income buyers who care more about cash flow than total lifetime cost? They might also like it. If you're planning to aggressively invest the difference between a 30-year payment and a 50-year payment into higher return assets, you could, in theory, come out ahead. Emphasis on "in theory," because that assumes very rational behavior and no impulse Tesla purchases. Builders and developers? They absolutely love this. When you expand the number of people who can afford current prices, demand doesn't stay flat. They can build more expensive houses, charge more, and justify higher price tags because the monthly payment still works. Banks and mortgage lenders? They are not crying about this. Longer loans mean more interest over time and more products to sell. 50-year fixed, 50-year adjustable, 50-year with a balloon, 50-year with points. Wall Street will turn this into mortgage-backed securities with 27-page names before we even finish this video. Sellers? More demand, more buyers, more ability to stretch prices. That's usually inflationary for home values unless supply massively rises at the same time. Spoiler, that almost never happens fast enough. Now the people who don't necessarily win, anyone hoping that prices will drop if we just wait long enough. If you give buyers cheaper monthly payments, you inject more affordability into demand, not into supply. Historically, when you make borrowing easier without building a ton of new homes, prices go up, not down. And people who value financial flexibility. If you hate being locked into long-term commitments, a 50-year mortgage is like getting married to your lender and then renewing the vows with their grandchildren. But wait, it gets even more important. What does this mean if you're an investor? If you're in real estate, you need to perk up because this has the potential to reshape how you model deals. First, rental demand. In theory, if 50-year mortgages become widely available and politically popular, more renters might jump into homeownership because the monthly payment gap between renting and owning shrinks. That could reduce rental demand at the margins. But here's the twist. If 50-year mortgages bid up home prices, then investors who already own property see their asset values increase. Higher values, plus slightly lower payments per month, could still make buying rentals attractive, if rents keep up. Second, cap rates and yields. If financing costs remain high but terms lengthen, investors can play more with leverage. A 50-year amortization lets you get a lower monthly cost, which might let a borderline deal still cash flow, especially on multifamily or long-term rental properties. But that comfort comes at the price of holding more risk for longer. If rents drop or interest rates spike if you're not fixed, that long amortization doesn't save you. Third, flips and short-term strategies. Flippers probably won't care much about the loan term directly, but they will care about what it does to demand. If more buyers can qualify at current interest rates, the buyer pool for your finished product expands. That can support ARV prices and shorten your days on market. Again, though, that assumes lenders don't put strict qualifiers on who can get a 50-year loan. If it's tightly controlled or only available to certain groups, the impact could be more muted. Fourth, long-term macro risk. From a macro perspective, if the U.S. normalizes 50-year mortgages, you're turning housing more and more into a financial product and less into a thing people actually pay off. For investors, that might mean more financialization of housing, securitized products, derivatives, and new ways to slice and dice these loans. More sensitivity to interest rates. The longer the loan, the more sensitive its value is to rate changes. That matters for banks' balance sheets, pension funds, and hedge funds. Larger, too-big-to-fail style issues if anything goes wrong, because now you've chained households to lenders over half a century. So, how do you play this if you're an investor or just a financially literate human who doesn't want to get wrecked? Here's what to watch next. Number 1, the details of how this would actually be implemented. Is this going to be fully backed by government programs, offered only to first-time buyers, targeted at new construction, available across the board? The more widely it's offered, the more likely it is to push prices up. The more restricted it is, the more likely it just helps specific demographic groups without totally rewriting the landscape. Number 2, underwriting standards. If lenders lower standards while expanding terms, that's when people should start getting flashbacks to 2006. If they keep underwriting tight, verifying income, requiring decent credit scores, enforcing debt-to-income ratios, then the blow-up risk goes down, but the number of people who can actually get these loans might be more limited. Number 3, what happens with interest rates? This entire conversation looks very different at 3% versus 7%. At 3%, a 50-year mortgage looks less insane from a total interest standpoint, even though it's still a long time. At 7% or higher, 50 years becomes punishing in terms of total interest, and you're basically signing up to be a lifetime subscriber to your own debt. Number 4. Supply. This is the boring but crucial thing no one in politics likes to talk about. You don't fix housing affordability with creative spreadsheets alone. If zoning laws don't change, if building costs don't come down, if we don't actually construct more units, then all we've done is pump helium into the same balloon and hope it doesn't pop. If 50-year mortgages roll out with serious reforms that make it easier to build more housing, the impact might be helpful overall. If they roll out on their own without supply reform, look out for higher prices and more frustration. And here's where things get even wilder from a personal finance angle. Let's say you're 30 years old and you take a 50-year mortgage. You'll be 80 when you finally own the home free and clear. Best case, you build wealth carefully, ride appreciation, maybe even refinance if rates drop later. Worst case, life happens. Job loss, divorce, health issues, local economic decay, and you're stuck with a huge balance that never really shrinks because you've been paying mostly interest for decades. If you're older, say you're 45 or 50, and you sign a 50-year loan, you are almost definitely not going to see the end of that mortgage personally. You're essentially tying your estate, your heirs, or whoever inherits the property into that structure. That's fine if it's intentional and planned, but it's a huge decision. What if you're younger and more financially educated? One potential strategy: take the 50-year for the lower payment, but treat it like a 30-year by paying extra principal aggressively whenever you can. That gives you flexibility in bad months and savings in good months. But, and this is a big but, the majority of people do not do that consistently. Most people optimize for the minimum payment and then live up to their income, not under it. So there's a very real risk the average buyer just says, "Sweet, lower payment," and never thinks deeply about the long-term cost. So, what do you do with all of this as an investor or just a rational human trying to survive late-stage capitalism? If you're thinking about buying a house, ask yourself, do I want a lower monthly payment, or do I want to actually own this thing one day? If you view a home as a place to live and you care about security and ownership, a 50-year mortgage might be a tool, not a goal. You might use it temporarily and refinance later if rates drop. If you view a home more like a leveraged way to park money in an appreciating asset, then the term length becomes more of a math problem. Just run the numbers on total interest, alternative returns, and your realistic time horizon. If you're a real estate investor, start modeling deals with the possibility that 40 or 50-year terms become normal in the next cycle. How does that change your buy box? Does it make sense to lock in long-term fixed-rate debt if you think inflation and rates will stay higher? Also, think about renter psychology. If more people can become owners, who is left in the rental pool? Usually, it's people with more volatile incomes, weaker credit, or more mobile lifestyles. That changes default risk and vacancy patterns. If you're a renter waiting for a crash, don't assume that higher rates plus long-term loans equals guaranteed crash. Policy changes like this can delay or distort normal market corrections for years. You don't have to FOMO into a bad deal, but you should stay realistic. Political systems will happily bend math to avoid letting housing values collapse. And above everything else, remember one thing: a mortgage is not just a monthly payment. It's a 30, 40, or 50-year relationship with the future version of yourself. Don't volunteer that future version for a life of debt servitude just because a politician said, "Hey, we made it more affordable." Before we wrap up, let's tie this together. Trump's 50-year mortgage push is not just a quirky idea. It's part of a bigger pattern. Instead of fixing the root problem, lack of supply, zoning choke points, construction costs, we keep tinkering with the financing knobs. Every time we do that, we usually help some people in the short term, but we also pump more air into the housing bubble long term. If this actually happens, yes, it could help buyers get in the door. It could reshape investor strategies. It could keep home prices supported even in a high-rate environment. But it also risks turning the American dream of owning a home into the American reality of renting money for life. Now I want to hear from you. Would you ever take a 50-year mortgage? Is that a smart hack for lower payments and flexibility, or a slow-motion financial trap that politicians are papering over with nice-sounding words? Drop your hot takes in the comments. Are you team, whatever, just get me a house, or team, I'd rather actually own something before I die? If you got value out of this breakdown, hit that like button so more people see what's really going on behind the headlines. Subscribe to the comment section with Thomas Paul for more deep dives into the weird intersection of politics, money, and the economy, where the policies are made up, but the payments are very, very real. Thanks for watching, and I'll see you in the next one.